Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
Welcome to this Friday episode, a special Q&A today. I'm joined by Mitchell, our Head of Funds Management at Rask. Mitchell's here in the hot seat today for a special Q&A session all about investing because Owen is still down and out sick. So Mitchell, thanks for joining me today.
My pleasure, Gemma. Thanks for having me.
No worries. So Owen and I always start these with what's been happening in our week. So what's been going on? What's happening in Melbourne?
My week has been really hectic. I've been solo dadding. I've got a 3-year-old and my partner is in Bali on a little girls trip. So she's having, daiquiris and Mai Tais by the pool, and I am keeping it down at home.
Are you up to your elbows in chicken nuggets and tantrums?
Look, I haven't had that many chicken nuggets. No, we've been pretty good eating, cooking at home. I have taken him we had robot sushi, or just sushi on the weekend that a robot brings to you. It's one of his favorites.
Oh, that's very cool. Yeah.
He even got a little photo of the robot. But I think he's had chicken nuggets once. So I think I'm doing pretty all right.
For 3, wow, that you are doing very well. Actually, I have a question for you. So this has come up quite a few times. It's been a bit of a heated debate and a theme through this podcast since Owen has had his first baby. Your baby's probably out of nappies now, but what was your newborn nappy of choice?
I think it was Huggies. I'm pretty certain. I remember thinking at the time. I remember the characters on them. Like Huggies have always have the specific characters. Right now we're toilet training and he's pretty almost there. But overnight we'll put him in a nappy, and it's a Bluey, the Bluey nappy.
Of course, Blueies would be into nappy. Oh, they're on everything, right?
Yeah. So that's Huggies. But I think the babyish ones, I think there was Winnie the Pooh, and then I think there was Mickey Mouse as well. So I think it was all. I'm pretty certain that it's Huggies that have all of those characters.
Yeah, the consensus so far has been Huggies for the newborn, and I think I'll just keep asking people, and if the consensus stays like that, I'll probably try to get them as a sponsor. Yeah,
look, I remember thinking that when you were properly in the trenches with a newborn, now in hindsight, it seems really easy, doesn't it? Like all they do is just sleep and eat. But I just remember thinking half of the world's landfill must be nappies.
Yes.
Just the rate at which we're going through them.
Owen did some research around it in one of the episodes because it came up that, why wasn't he using reusables? And this is where, of course, he then dived into some research around it. But yeah, it was really interesting. So I thought anytime I have somebody new on that's got a young child, I'm just going to ask them from now. But yeah, cool. Okay, so single dadding. My week this week is I'm also single parenting, but that's because I'm a single parent half the time. Some interesting stuff's been happening in the news. We've heard about the 60 million that's being refunded, bank fees by, I think it was Westpac, ANZ and Bendigo Bank are in the news this week. So that's been pretty interesting. But yeah, other than that, excited to get into this Q&A, and we've actually pulled out. So every week in these, Owen and I tend to get a bit of a mix on whether it's, mindset questions, cash flow, debt questions, a bit of everything. And we like a bit of a variety. But because you are an investing guru and usually on the investor podcast, I thought that I would pull out just investor questions and put you in the hot seat. So these are all for you.
I don't know if I've ever been referred to as a guru, but
I'm just going to put you on the spot. These are all for you. All right. So we also like to make sure we encourage people to send through funny names. So I think we've got some good ones today. Only one that I think might be their real name. But really importantly for the listeners out there, anything that we talk about is general in nature. None of these are personal recommendations. We might actually speak about things that are actual shares, actual products or strategies. This is not a recommendation. We don't know your needs, objectives, your goals, your personal situation. So it's really important that you understand this is general. It's for education, information and entertainment purposes. You need to make sure that you get advice for your own situation before you take any action. So the first question is from Conservative Cat. I am 48 years old. I have a Rask Invest account and I'm interested in your financial advice packages. I will likely choose one of the package options. I'm looking at getting advice around investing in shares. Is the advice fee tax deductible? I can't find conclusive info on it.
Not being able to find conclusive information on tax-related matters is the norm. Even if you go on to like the ATO community website and things like that, you can find contradicting answers to similar situations left, right and center. And that is why you're not going to be overly happy with my answer, Conservative Cat, but that is a question for your accountant. Anything tax relating, it's absolutely best to speak with your accountant. I did speak with our advisors in the office here yesterday when Gemma sent this question through to me, and they did say there's a bit of a new tax ruling to the extent of the advice that relates to tax advice. So some of the financial planning will relate to that, and that proportion of the fee may be tax deductible. But long story short, that's a great question for your accountant. And thank you very much, though, for being a Rask Invest investor. I'm sure we may have spoken in the past. I don't know who this Conservative Cat is, but obviously not that conservative. In your question, you've actually put you're invested in the Jupiter model, which is our high growth model, our 90-10 split between growth and defensive assets. So not that conservative a cat.
So I love this one. So yes, there is a portion of advice fees that generally could be tax deductible, but it depends on what the advice is linked to and all of that kind of stuff. It's like when you, people want to see if there's a portion of their advice fee that can be deducted from their super account. And it's like, well, it depends how much of the advice is actually to do with super and how much is outside of super. So it really, really depends, but it'll depend on, what actually elements of the super, and then we need to chat to the accountant as well. Next one is from Cara. As a beginner building a 2 exchange traded fund core portfolio, how would you go about finding 2 suitable individual stocks to invest in? Mitch, what would you say about this? So core portfolio, she wants to find 2. What are you thinking?
So I'm certainly not going to sit here and say just 2 random stocks. I'm going to presume, Cara, you have your 2 ETFs down pat. You've got that sorted, and you want to add these stocks as a bit of a satellite component to a core portfolio, and then something smaller to provide diversification, provide potential outperformance, or just really to pique your interest and keep you engaged with the portfolio. And so how I've taken my answer to this question is more about how I'd go about finding those 2 stocks rather than just give you 2. I would start with it's a twofold thing. I'd start with developing your own investment style. Every single good investor that I know out there has evolved an investment style that sits with their personality really well over time. And how you do that is just by gradual learning. So jumping across from time to time, say to the Investors Podcast, and I do a lot of interviews with fund managers who all have, their little ways that they look at the world and look at stocks. Reading widely, a great book that I've got sitting on my table and I've reread it every now and then is One Up on Wall Street by Peter Lynch. He's one of the best investors of all time. And then there's the Warren Buffett letters from Berkshire Hathaway. There's lots of different books out there. But just reading them and you'll gradually develop your own style. You'll pick and choose what kind of makes sense to you. At the same time, start with what you know. So if you work in You might work in a supermarket. You might really be intimately familiar with how that business works. You might be in retail. You might be in some kind of business services, and you use Salesforce. You use Microsoft. Just look around your house and look at the products that you've used every single day of your life, like Colgate, L'Oreal, things like that. These are all listed companies, and you're really familiar with them. Or go for a walk to a shopping center, right? Walk through a shopping center and you'll see JB Hi-Fi, you'll see Leviza. You can go into a supermarket and see like A2 Milk, all sorts of things that are listed. And so start there with what you're comfortable with and what you're familiar with. I don't know exactly when this episode goes out, Gemma. You said Friday, is that right?
Friday, yes.
Yeah, this Friday?
Mm-hmm.
Okay, cool. So rewind and go to the Investors Podcast. I had a great chat with Tim Carlton, who's a fund manager, and he also, he lectures or guest lectures at Sydney University in a select little course on portfolio management and investment and whatnot. And one exercise he does is he gets the students to write down all these different sectors like telecommunications, retail, mining, blah, 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 blah. He gets to write them all down, and then he gets them to order what they're most familiar with in their day-to-day. And so then they'll, obviously JB Hi-Fi and things like that are up the top, Telstra maybe, because they've been using Telstra all their life. And then he gets them to actually line up their portfolio that they've created themselves in the weights with the weightings and see what best aligns, how that stacks up against what they're most familiar with. And inevitably what he finds is the most complex businesses that they're the least familiar with, they're invested in the most. And so that's risk. That's a whole lot of risk. So starting with what you know, I think that's a fantastic way to just get out there and get your hands on the product. And yeah, so where you work, what you use day to day, I think that's a good way to start to explore the world of stock picking and investing, and start small, because your mistakes, as you'll inevitably make them, we all do, your mistakes will hurt you less. So if you've got, a couple of $100,000 and you're just getting started, maybe carve off $10,000 and just use that. Don't all of a sudden just go out and pick big stocks, because your mistakes will be incredibly costly, and we call them your tuition fees. So keep your tuition fees pretty low.
We talk a lot about like educating kids as well on money, and and stocks and how businesses make money in shares, and that going out and walking around the shops and looking at that, like the stores and what brands and things they see, that what you spoke about just then is exactly how we talk to kids about money as well. Like go and have a look at the brands, and then let's see if they're listed, and that's what shares and companies and all of that stuff is. So that's a great place to start for anyone at any age, even if that's where you want to start your kids learning about money.
Yeah, I really like narratives. And I like to reconstruct the narrative of a business. Go back 10 years. And so JB Hi-Fi, for example, has been a fantastic stock on the Australian stock market. A lot of people might not know that. But I remember walking into my very first JB Hi-Fi as like a 12 or 13-year-old. It was in Katara near Newcastle. And I was like blown away. And it would have been amazing if I bought stock then. But going back and seeing, say, how JB Hi-Fi has weathered the storm of competition against Amazon and still done really, really well, that's fascinating. So just literally walking around a shopping center, you'll find amazing companies like Leviza, for example, that sells the jewelry, the really, really small stores, but incredibly profitable, wonderful business. Another business like Nick Scali, for example, the furniture business, they're family-run business, listed on the stock market, one of the best retailers in Australia, expanding into the UK. So you can, really get a hands-on feel for the service, the product, and that kind of thing.
Yeah, yep, amazing. That's a great tip. All right, moving on. We are loony for leverage. Okay, this is a really interesting one, and it's off the back of a recent podcast. I was recently listening to your podcast with Cameron from Betashares about gearing ETFs. For longer term investors, 10 plus years, is volatility decay something that will significantly impact your returns? From my limited understanding, portfolio rebalancing and market volatility can mean geared funds underperform relative to their risk in the long term. Is it true? And how does this factor into your long-term views on geared funds?
It's a really good question, Looney, for leverage. And I personally have never invested in a leveraged fund, but I think what you're looking at there, the risk for the return, just because, and this goes into what the volatility decay talks into it. Maybe we'll link to that episode as well in the show notes, because I'm sure Cameron can explain it a lot better than I can. But essentially, if you've got a geared ETF, for example, and it's, you're getting twice as much as the amount of exposure to Australian equities as a non-geared ETF, you're actually not going to get twice the return. You've got volatility decay, which means, because the prices, essentially the investments are reset daily internally with the ETF, it means the returns don't compound in the same way, really, especially in volatile and sideways markets. Also, you've got to take into consideration the cost of the gearing as well. So they're paying an interest on that, and so that comes away from the return. So what you were talking about there is the risk for return. Hey, you're not getting a 2 times the market return, you're getting 1 and a bit times, but you are taking additional risk. So that's what you've got to think about with gearing. One interesting way that I have seen gearing used, once again, I don't use it, and it also comes back, I should say, to your goals and why you're using it. Do you need to? Like, can you hit your goal without having to leverage? Because you are taking on additional risk. If you can hit your goal without having to do it, why would you do it?
Yeah, one of our favorite sayings, or one of my favorite, and in financial planning, we always say, just because you can doesn't mean you should.
Yeah, just because you could doesn't mean you should. And that's 100%. It's really managing a portfolio is trying to take the least amount of risk to get to where you need to go. It doesn't mean you have to take the market risk even if you don't even need a market return. Don't put yourself out there to get that. That's just focus on what you need, not what the market's giving you or someone else is going to give you. Also, how I've seen gearing used in an interesting way is actually from, say you've got a geared Australian equity ETF just tracking the ASX 200 but geared. I have seen people use that so they can put, and they hypothetically imagine you want 40% of your portfolio exposed to Australian equities. Well, they might put 20% of their actual cash into a geared ETF to give them that enhanced exposure to that asset class, and then leaving them with more of their cash to invest, say, in international. So you can get, for less of your money, you can get more exposure to it, exposed to the return, and being able to then, say, dial up your international exposure. That's how I have seen it used in an interesting way.
Next question comes from Stuck. Hello, let's say hypothetically, looking at another core ETF to diversify my portfolio outside my current holdings of VAS and VGS/VGAD. Can you offer any suggestions to add to this? I'm considering VAE. Do you have an opinion on this ETF, as I don't hear it discussed a lot? So really importantly, we can absolutely not give any advice. I guess what we could just touch on is the underlying assets or some opinions on those, but really importantly, we can't give any advice.
Right. So I don't know if you're telling that to me or to the listeners, but essentially I'm going to start with the name, Stuck. Why are you stuck? Why do you think you need to add this in? I actually talk to a lot of people, and I do see them actually get stuck. They get twisted up in the analysis of ETFs and trying to compare this with that and get the most perfect.
Analysis paralysis.
Yeah, trying to get the most perfect portfolio before they start. A perfect portfolio doesn't exist because, hey, another good ETF is going to come out in a couple of years' time. It's going to do it cheaper. I would rather just get started and you can find your way from there, especially when you are investing in really broad-based ETFs like VAS. The Vanguard ASX shares ETF is the ASX 300, so the 300 largest listed companies here in Australia. It's dirt cheap. Vanguard have a history of lowering their fees as well. So that is actually why we've chosen it in the Rask Invest portfolios for some of our Australian share exposure. VGS is the Vanguard International Shares ETF. VGAD, which you've mentioned in the question as well, is the hedged version. So already there, you've got I think you're coming up to about 2,000 companies. Okay, so you're pretty diversified. VGS, the Vanguard International ETF, that takes care of all of the developed markets in the world, excluding Australia. So I think that's about 22 countries. Of course, it's market cap weighted, which means it holds, the bigger the company, the more it's represented in the ETF. So I think about 75%, or maybe a little bit more these days, is actually US. And then it goes around the rest of the world. So Europe, UK, etc. So start with why you're adding VAE. Now, VAE is an interesting ETF. And it's got a far higher management expense ratio, I should say, as well to the other ones. That's the fees that it charges. But what VAE is a Vanguard Asian ETF. And so that invests in the Asian region, excluding Japan and excluding Australia and New Zealand. So the two largest components to that ETF are China and India. Then you've got South Korea and Taiwan. They make up, I think, they're all the ones that are above double-digit positions. And so it's a passive ETF, so it just invests in the biggest companies that are listed in those regions. So it's essentially, when you look at it, like a more of a geographically, like a Asian-focused emerging market ETF. So whenever you're looking at a specific ETF, knowingly or unknowingly, you're actually excluding other options because investing is always a trade-off. And so when looking at VAE, you might want to look at something like iShares Asian 50, which is the 50 largest companies in Asia. IAA is the stock code for that. You might want to look at but the trade-off there is that doesn't include India. And India's been one of the fastest and most dynamic growing stock markets in the world over the last decade. I've got an interview on the Investors podcast with Mugunthan Siva from India Avenue, which is an Indian ETF. That's a really interesting story. So you can also compare VAE, because of that emerging market exposure, to something like an iShares Emerging Market Index ETF. IEM is the stock code for that as well. So it just depends on why you're actually adding this. Do you think you need to diversify more around the world? Do you specifically want Asia? Do you think Asia is going to be a good bet for the long term? If you want specific countries from Asia, you can get those. You can pull them out and exclude the rest if you want China, for example, or if you just want China tech. So the other thing as well, if you're doing this for diversification's sake and you just hold two ETFs or a couple of ETFs, perhaps think about diversifying as well away from Australian and international equities. There are other asset classes out there, and what we try to do from a portfolio management perspective is combine multiple asset classes that have different return profiles so we can lower our volatility of the portfolio without hampering our total return. So, yeah, bit of food for thought there.
Yeah, I find that when people try to diversify themselves, a lot of the time they diversify into different ETFs that have similar asset class and holdings. And so what they're actually doing is diversifying against different ETF managers, but actually have the same exposures.
Yeah, a lot of these countries would not be in VGS, for example, because they are, even though a lot of them are incredibly advanced countries, they're still flagged as emerging market. Why, like, for example, South Korea is flagged as an emerging market. It's got companies like Samsung, for example, has emerged, I would suggest.
Well, the next one, actually, you probably answered a lot of it for newbie, but let me read out the next question. But I think we might have covered it. The next one by a newbie is, I've just started investing and keen to hear about diversification. So you would have got a lot out of that question. Isn't buying two broad ETFs like VAS and VGS already diversified enough? Do I need more? So I think the answer would be, you need more if you feel like that isn't enough diversification.
Yeah, so once again, with VAS and VGS, it's actually a lot of portfolio construction as well. It comes down to getting your split between the asset classes correct. So like how much VAS, how much VGS. So that then comes down to your personal preferences, your personal circumstances on how much growth and defensive, because VGS, you are adding in an additional element of risk, being currency risk. There you've got currencies from all over the world that are represented in that ETF. But if you think about a lot of companies as well in VGS, they are truly global businesses. Like, I'm sitting here and I think I've got 6 Apple products in front of me. Like, literally, they are. It's the companies in that ETF are truly global businesses. If you think of like the likes of, I've already mentioned L'Oreal, for example, LVMH as well. You get exposure to those businesses in VGX, and they are truly global. So it comes back down to that diversification of asset classes. So we want to diversify across and within asset classes, and you want them to be doing different things at different points of the cycle. So you get a smooth blended return. I know a lot of people, especially younger investors or people who have a really long runway ahead of them to invest, don't like to hold cash or bonds, those defensive style assets. But if they you might manage that yourself directly through a high interest savings account, for example. But why we do include those in let's say a high growth portfolio, even at a small percentage, is it gives us the ability to rebalance. And so say if the market pulls back dramatically, if we didn't have any cash or defensive assets, we couldn't go on attack.
Yeah, that opportunity.
Well. Yeah, so that's why, and I'm just answering my own question here. That's why we use those defensive assets, even in a high growth portfolio. So that kind of diversification helps us.
Perfect. And the final question before we wrap up is from Fee Conscious. So when comparing ETFs, how much weight should I give to management fees? Is a 0.3 fee versus a 0.1% fee a deal breaker? What is most important? This is a really common one. We get this a lot. And we talked about analysis paralysis earlier with picking the different kinds of ETFs. And I honestly see it come down so much to, yes, the underlying assets in them, but also the fees. People get so stuck on the fees. So run us through, is it a deal breaker? Why is it so important?
It is the last thing I look at. I'll put it that way. I start really by, when looking at an ETF, it's like, firstly, do I want this exposure? Like, do I, so we have internally what we go by what we call our best expression. So we want to hold what we believe is the best expression of that asset class or that sector or region or thematic that we want to get exposure to. Sometimes that'll be ultra low cost passive in areas that we think are ultra efficient, like so Australian large caps, US large caps, like it's very difficult to beat the index. So when it's incredibly difficult to beat the index, we just want really cheap index exposure. So for example, if you look at iShares S&P 500 ETF, which is the ticker code IVV, it's what we use for our US exposure. That's got a management expense ratio of 0.04% per annum, I think. Look, another ETF issuer could come out in a few years and beat that, but your switching costs to get into it wouldn't make sense, really. So yeah, fees are important, but I do. I have to take everything in a portfolio context as well. And so I think that's where a lot of people do let themselves down when comparing ETFs. They don't think about your portfolio composition as a whole. And so for us, and myself personally, I blend active and passive depending on what exposures I want. For example, I can't get small cap exposure, good small cap exposure in an ETF domestically because of liquidity constraints. It's just not going to happen. And so, but I don't want that as 90% of my portfolio. And so what I do and what we do is come up with a fee budget, right? So you might be happy to have 70% of your portfolio in really low cost passive ETFs because, you want the bulk of your exposure to be ASX 300, S&P 500, VGS, whatever it is. But then, and so because they have maybe 0.07% of a management fee, that gives you room in your fee budget to add in something that's a bit higher. And so when you look at that total of your portfolio as a weighted average, your total fee in that portfolio that you're paying might be 0.2.
Yeah. So it's almost like a core satellite approach, but for fees. It's like, well, the core of my fees is so low that I can afford to have some more expensive assets in here.
Yeah, exactly. You can add on like a 10% position in a global active fund manager ETF, which is something that we have done. That charges a higher fee because you're paying for analysts who travel to these countries, have boots on the ground.
We talked about that the other day. We talked about some very interesting things that fund managers do that are worth paying for.
Yeah, is this my analogy about A2 milk?
No, you were saying about a fund manager that sends people over to different countries to try out different services and live in the countries for a few months to try out different, I can't remember the example that you gave.
Yeah, so you're referring to, I had a chat just last week, it's on the Investors podcast, with a Canadian small cap fund manager. He invests globally. His name's Greg Dean. Really good, really, really lovely guy, despite him calling me Owen at the end.
You were like, we were best mates, and then he called me Owen.
We're chatting for an hour, Greg. Come on. But what he does is called investing like a local. So from time to time, if they get a clump of companies that they're looking at and they're really keen on, what he will do is say, right, rightio, analyst or himself, go over to that country and live there and use the products in that setting. And so he told me a story about how he took his family for a month or 2 months over the summer to Paris, just outside of Paris, and lived there because they had a lot of companies in France that they were looking for. Another analogy, because I just teased people with it, about the additional work that fund managers do that can add value, is I interviewed quite a while ago now, a guy called Andrew Mitchell from an Australian-based fund manager called Ophir. And he told me this fantastic story about how he invested in, or got the confidence to invest in A2 Milk. And what him and his team did was, and this goes back to the previous question of, hey, how can I get started in maybe stock picking and starting with what you know? They went out and they just bought a tin of baby formula. And they said, right, what information is here already on this product that can help us analyze this business? And they, after, looking at the tin and turning it upside down, and I'm sure they probably even gave it a taste test, they saw that the tin of formula had a made by, a manufactured date on it. And so they thought, oh, that's interesting. And so they just started tracking the manufactured date. They would go week by week into Coles and Woolworths and just pick up a tin, see the manufactured date, mark it down, and off they'd go. And they'd do that, but comparing it to A2 Milk and Bellamy's and the other ones. And what they noticed over time was the manufactured date range was coming shorter and shorter and shorter and shorter for A2 Milk, meaning they had to manufacture it quicker and quicker and quicker because they were making more of it, they were selling more of it, etc. And so they were able to get this piece, this data point, and that they would have only have gotten from going out there and actually picking up the product. And they were able to send team members into supermarkets and just build this data point. And then they said, yep, it's time to buy A2 Milk. These sales are ramping up. And they did really, really well of it. So by paying a fee, you do get that. You don't get that from a 0.05% ETF. You get the broad market. And that's okay in a lot of instances. But when it comes back to, those more inefficient asset classes, that's where it can pay to have that on your side, and you can have your cake and eat it too. It's not, you don't want to be dogmatically one side of or the other of the passive versus active debate. There's a lot of grey area in the world. So, yeah.
Yeah. And they both have a place, right? It doesn't have to, definitely doesn't have to be one or the other. Excellent. Well, this was a fun one to go through and to put you in the hot seat, but just a quick recap. So we had conservative Cat going through our advice fees tax deductible. We had Cara talking about the core portfolio, but how to find individual stocks. We had Looney for leverage talking about volatility decay. We had Stuck asking about if they should be considering adding another another ETF to their portfolio. Newbie was wondering, they keep hearing about diversification and do they really need more? And then Fee Conscious is a fee really a deal breaker? So thank you so much for joining us, giving us your insights. Owen, it's been great having you for the 45 minutes.
Gemma, good to see you. And hopefully, when are we seeing you again in the Melbourne office?
I will be in Melbourne the week of August 18th. We have a new financial advisor joining the team, which is really, really exciting. Advice is going amazing. That team's growing really quickly. Actually, we probably should give a bit of an exciting update for advice. We have quite a bit of a wait list happening there at the moment, which is exciting. And we're just so thankful for everyone and their patience with that. But the uptake has been amazing, the expressions of interest. But we're really getting some statement of advices out the door now. Got some new advisors joining. We've got customer support, paraplanners and things happening. So it's really exciting. So I'll be there in a couple of weeks to onboard our newest member of the team.
Very good. All right, we'll catch up then.
Social committee better be on to something.
Yeah, for those listeners, I make up 50% of the Rask Group social committee. It's been a slow start, but we'll be ramping up. We do have 3 40ths in a row happening pretty soon.
All in September, I think.
Yeah, so it's big social committee events coming up.
Yeah, so if you can guess, you can put in the right into the questions who 2 of those 3 are. One of the people isn't a public person. They're in our advice team and they haven't been introduced. They don't have a public persona. The other two are on this podcast right now. Okay, thank you so much, Mitch. I will see you in 2 weeks.
Awesome. Catch you later. Bye.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.